Very good afternoon, good morning. Welcome to HYCM's online trading workshop with myself, Giles Copton. We're going to be looking at the Bank of Canada interest rate meeting today. Very warm welcome to you, Jabeen, Mohsen. Good to have you on board. Don't forget that as we look at the different entries, exits, different instruments, this is not designed to be trading advice. Instead, this is meant to be a opportunity to see how I, as a professional trader, go about making trading decisions. So you can see someone as they go about making those decisions. We'll be looking at the Bank of Canada. Now, remember the key principle in trading that we really want to understand is how to back strength against weakness. And if you can grasp this concept, it's the simplest concept that will really, really help you in your trading. And very simply, you can see this image. A strong arm should beat a weak arm in exactly the same way as we're looking to pair strength against weakness. We are looking for a strong currency and we're looking to pair it against a weak currency. When we do that, we have a much greater chance of the direction being correctly identified. Now, one of the key things we look at when we're trading is what the risk tone is. And this is a very helpful crib sheet, which just helps you to see whether the risk tone is positive or negative. So if you haven't seen this before, do take a look at it. Do take a screenshot. It will help you because when we have risk on trading, we expect yen weakness, Swiss franc weakness, US dollar weakness, particularly at the moment, and we expect Aussie, New Zealand dollar, CAD strength. When it's risk-off markets, we expect to see yen strength, Swiss franc strength, dollar strength, and then New Zealand dollar, Aussie dollar, and CAD weakness. So understanding the risk tone is one of the simplest ways you can quickly begin to focus in on a strong currency against a weaker currency. Now, today we have the Bank of Canada interest rate meeting coming up. And I'm just going to run through markets because we are in tricky markets right now. We just need to take a bit of time to assess where we actually are. The majority of asset classes have been very, very mixed as of late. I'm just going to go over to my trading screen. And we're going to just give ourselves a quick run through major markets. Now, commodities we can see have been pretty much low. We see copper has been tracking lower. Copper is called Dr. Copper because it gives you an indication of the overall health of the copper market. Now, if you just take a look at this from a weekly perspective, you can see we have just broken through this key trend line. So any retracements back down to that 4.3 region, we'd expect to find buyers on a first test. So look out for that, but also recognize that copper tends to flag up the risk tone. And if copper's falling, it means there's more likely to be a negative risk tone. And risk tone is quite mixed at the moment. One market we want to keep a very careful eye on is gold. Now, gold has tried to break out of that near-term trend line. We currently see price just sitting above that trend line. And what gold's trying to do is push its way higher. So watch out for potential support in gold coming. This is an ideal place to define and limit risk. Now, gold is driven by the interplay of three things: bond yields, inflation, and the US dollar. And what we want to see for gold is we want to see real yields falling and the dollar falling. That will be like lighting a rocket under gold. So this is what we want to see. I'll just take a look at this. Here we have the interplay between, excuse me, real yields, gold and the dollar. Now, if you notice, I'm using the tips here as a proxy for real yields. It's very close to real yields, and it is updated intraday. So you notice when the dollar's falling and real yields are falling, do you see how gold rises sharply? So when we have falling real yields, falling dollar, we have gold rising. Falling real yields, falling dollar, gold rising. Falling real yields, falling dollar, gold rising. So at the moment, we've got real yields falling, and if the dollar starts falling, expect gold to rise very sharply higher. Now look at the FOMC meeting next week. That could be an ideal opportunity for more gold upside. Okay, so watch out for that. Real yields are falling. That is bond yields minus inflation expectations. Now, if you look at inflation expectations, they have just been surging higher. These are the break-even inflation rates that are surging higher. So inflation is rising. That's what's dragging real yields so sharply lower. So going back to our gold chart, we can see gold starting to push higher. Now, as soon as the dollar weakens, then we can look at more potential upside in gold. Easy place to define the limit risk. Stay above that trend line, stay with it. Get back below, exit. So you can use that trend line to define a limit risk very tightly. Oil slightly pressured today. Don't forget we've got inventories level coming up at 3:30 today. Now, if we have a draw in inventories of say like 2 million, then expect sharp upside in oil. If we have a build in inventories above 4 million barrels, then expect a move lower in oil, but we are expecting medium-term buyers. So any retracement back down to 77, 78 remains suitable for buying. Okay? Any retracements back down to 77, 78 remain suitable for buying. So do keep that in mind. Okay? And the reason we expect buyers is low inventories, rising demand, and all of that should be supportive for oil medium term. The stocks can be just put quite tightly below the 74, 75 region. That would be a clever place to define and limit the risk. Now, the main event that we have coming up at 3 o'clock today is the Bank of Canada interest rate meeting, and this is what we need to look for. Now, should we go through the CAD? Now, can you see the CAD? Over the last few weeks, the CAD has been rising higher sharply. Why? Employment is getting back to pre-COVID-19 levels. Inflation is running at high levels. We also have the fact that oil prices are moving higher, and oil is a petrocurrency alongside the Russian ruble and the Norwegian krona. So when oil rises, it boosts the Russian ruble, Norwegian krona, CAD. So all the good news for the Bank of Canada is pretty much priced in. Now, what we're expecting from the Bank of Canada is that they reduce 1 billion Canadian dollars in tapering and leave $1 billion of tapering still allowed. Now, look out. If they announce an early end to quantitative easing today, so if they say we're going to finish quantitative easing, and if they say we're going to expect interest rate hikes to come in the first half of 2022, then look for upside in CAD. And one area we look for is something like a pound CAD short. So look out for a pound CAD short. This is how it would look. This is how we define. This is how we limit the risk. Pound CAD. Here we go. We just look at the pound CAD short here. And we'd be looking for a potential move lower back down to that trend line, okay? So if we have a very, very hawkish outcome, if we see an early end to quantitative easing, and we see a interest rate hike projection brought forward, expect pound CAD downside, and we can use this trend line to define and limit our risk, okay? Getting back below, staying below, that will define and limit the risk. So look at that trend line there. That would be ideal if we have a very hawkish Bank of Canada. Now, if by in the other hand, we have a dovish outcome. So they announced the $1 billion taper. That's what's expected. That's already priced in. And they leave the rate projections unchanged. That will be disappointing. So we can easily expect downside in CAD. And then we might want to look something like Aussie CAD long. Like, I'll show you why. Risk tone is a bit mixed, so we have to be aware. It's either an Aussie CAD long or a US dollar CAD long. The Australian inflation data came out pretty high last week. Now, the Australian dollar is pretty heavily sold right now. If we just take a look at the COT report, you can see here on the COT report how heavily sold the Australian dollar is. And leverage funds, that tends to be fast FX money, and asset managers are all quite heavily short the Australian dollar. So that means that if we do have a dovish outcome, it wouldn't be surprising to see a little bit upside in the Aussie CAD, because there's been some high inflation data that came out. That is within the 2 to 3% target, the Reserve Bank of Australia. The Reserve Bank of Australia at the moment aren't expected to raise interest rates until 2024. So that means these inflation expectations give some of those traders who are already short a potential to remove some of those short positions. So that in itself should potentially help the Australian dollar CAD higher if we have a dovish Bank of Canada. So look for a potential more upside in the Aussie CAD. Okay, and you can see here, we just see this trend line here. That would be a good place to find them at risk. If we get and stay above that, then expect a little bit more upside in the Aussie CAD potentially. It's one to look out for. And we'll just have a look at the bond yield spread between the Australian dollar 10-year yield and the Canadian 10-year. We'll just have a look at the bond yield spread. And this is what we see. Yeah, look, and you can see that bond yield spread moving higher, okay? And you see how price tracks the bond yield spread? This is the difference between the yield in the Canadian 10-year and the Aussie 10-year. So this move higher in the Aussie CAD 10-year spread, you can see that breakout of that level. You see, if we just take that, off, 1, 2, 3 touches, breakout, retest, moving higher. That does indicate that, that could be potentially signaling an early break of that trend line here. So if we saw a dovish Bank of Canada, if they announce 1 billion taper but leave rate hike projections unchanged, then look at the Aussie CAD. That could be a great opportunity. Now also look at the dollar. The dollar's sinking, and that's what's lifting gold at the moment. So you can see gold is being lifted on that weak dollar. So we know that the dollar is showing signs of weakness. We know that real yields are falling. So that should be giving some more upside to gold than we're seeing, which is a bit strange. But we would anticipate more upside in gold, so keep your eye out for that. As you can see, markets are quite tricky. And talking of tricky markets, we can see that equity markets are really pushed higher. Now, at the moment, we're having earnings season, and we've got a couple of big names out of the Dow Jones having their earnings later on today. McDonald's, Boeing, and what investors are going to be looking at with earnings is they're going to be looking very, very carefully at the future projections for some of these big companies. And markets are very nervous about supply chain problems, higher input costs from rising wages, rising raw materials. There's general concern that, look, S&P 500 all-time highs, Dow all-time highs, NASDAQ just trying to push above 15,700 for all-time highs, FTSE 100 heavily supported. All of this means that many investors are expecting more upside. Look at the VIX. That's the best way to indicate what's happening. You can see here, when I overlay the S&P 500 over the VIX. Now, the VIX is the options market analysis of how many traders are using call options and how many are using put options. So you can see that we're around that 15% region. So when investors are scared in the stock markets, they tend to purchase put options, which is expecting lower equity prices. You can see when the VIX rises, stocks fall. Rising VIX, falling stocks. Rising VIX, falling stocks. Rising VIX, falling stocks. This is the S&P 500 in the turquoise. Rising VIX, falling stocks. Falling VIX, rising stocks. If the VIX rises again, and look, we're in this near-term support, earnings could be key. So if we see worries about future earnings, worries about supply chain costs, worry about higher input costs, downgrades for future earnings, we expect the VIX to spike higher and the S&P 500 to drop lower. So that's what we want to be really looking at as we come into the session. Medium term, we have an upside bias in stocks, low interest rates, broad fiscal stimulus still in place in many areas. And so these are advantageous circumstances and situations for companies. But we have to be mindful of the fact that markets are very extended. So if you do look at entering, define, limit risk, make sure you're using very sensible stops and entries and exits with these kinds of trades. Looking at the currency pair, another currency pair that we quite like is the New Zealand dollar, Japanese yen. Now, notice here we're starting to see a little bit of a divergence between the bond yield spread and price. So bond yield spread's pushing higher between the New Zealand 10-year and Japanese yen 10 years, but price is pushing lower. So any deeper retracements, we expect to find buyers. We have found buyers today. Staying above that trend line does keep the case open for buyers. Found a bit of support at that 200 exponential moving average. We're now finding a little bit of resistance at the 100 exponential moving average. If that bond yield spread keeps moving higher, then that should drag prices higher. From a medium-term perspective, my personal preference is I want to see this rotate a little bit lower. So for me, I would like to see a move lower back down into this region here. If we just change the scale. Back down to that 80 region, I'd feel happier looking for an entry there around that 80-20 region. That would be a much happier region for going long. Now, look at the bond yield spread. This is the fact that RBNZ is expected to hike interest rates 4 times next year. Bank of Japan isn't expected to hike interest rates at all for the foreseeable future. So it's been a huge difference. And we see, the pair's been on a rip recently, and yen weakness has been pretty pronounced, and in fact it still is. So we're looking for upside in this pair rather than downside. So any deeper dips remain suitable for buying. Similarly with the Australian dollar, Japanese yen pair. Okay, folks, just looking at the questions. Has anyone got any questions about what's coming up? Yeah, thanks, Johan. Yeah, I've just seen your question, your comment when I was sneezing. Apologies for that. Any questions? Anything you want to know? Just while you're waiting for questions, I'll show you a little trade that I've just gone in, and it's sort of working out quite nicely. Now, this isn't. You might think, oh, this is me making it up. I did this with this trade with a large community of traders that I'm involved in. So it's not after the effect. It's not after the event. But what I'm doing is a learning point. And you can see that the euro pound has a sell bias, okay? And you can see, if you just look at the bond yield spread between German 10 years and UK 10 years, you see how the way that bond yield spread has been moving lower, but then price has been moved lower as well, right? Now, recently, we saw it was last night, we saw a divergence between the bond yield spread and price. So do you see that divergence? And let me just show you what it was. So price is making, higher lows. So the bond yield spread was making higher lows, but the price was making lower highs, right? So that divergence. Now, what happens is that either the yield spread is going to catch up with price, or price is going to catch up with yield spread. Now, the reason we thought that the pound was going to retrace further was because of the following reasons. It's to do with these SONIA futures. Now, let me just show you. Now, SONIA futures, you see the way they drop lower? Now, these drop lower when interest rate hikes are expected to come. So the way you work them out is you take the current rate, 0.10%, and you look at what like the December current rate is, it's 99.57. So you add 0.10 to 99.57, that takes you to 67, and then that gives you 33%. So the implied tightening by December 2021 is 0.33%. So that's 10 basis point rate hikes expected from the Bank of England. Now, if you go into 2022 December, you can see that the implied contract rate is a full 1%, because 98.89, add the current 10 basis points, that's 99.99, and then that gives you 100, and 1 basis points left over. So that means the implied tightening by December 2022 is 1%. That's 4 25 basis points interest rate hikes. Now, is that going to happen? Is the Bank of England honestly going to raise interest rates 4 times next year, once this year? So that's 5 25 basis points interest rate, very unlikely. So what that meant is, knowing that and analyzing that, we realized that, this strength in the pound looks a little bit overdone, and we were looking for some kind of retracement, some kind of recognition. Now, we went long, a number of us, just around that 0.8417 region yesterday, just looking for a move back up to this area, and we've got the ECB interest rate meeting tomorrow. Now, the ECB could change the outlook for the euro pound. They could say, we're going to recognize inflation expectations. Maybe they're going to end asset purchases more quickly. Maybe they're going to announce the bringing forward of the rate hike projections. I don't think they will do any of that. And the expectations are simply that it's going to be a holding meeting, right? But I've taken half of my position off at overhead resistance, and I've left the other half position at break even, okay? So I'm just going to, as it were, throw it to the wind. You know what I mean? Just see what happens. The potential for more upside is potentially quite good if we have an ECB shift. If we don't, then that will just rotate lower. But either way, worth just keeping an eye on, particularly as we come into that meeting. If we get through there, go above that trend line as bullish, and then back up to that 8.550 is on the cards if we can get back above that trend line. But it's just a nice little trade that we're looking at. And also, for those of you who know, some candlestick chart patterns, there was a nice sort of, we had a Harami inside bar, and that's really a false break of a Harami inside bar. And we also had a false break of a Harami inside bar on the pound US dollar pair. This is another trade that I went long on earlier in the session. So I went short on earlier in the session, and it was just recognizing that the number of worries coming into the UK. So there's rising COVID-19 deaths. There is the outlook for the Bank of England potentially raising interest rates too soon. And if they do raise interest rates too soon, they could stifle growth. There is the EU-UK Brexit negotiations going on. Energy crunch in the United Kingdom, particularly with nat gas prices being so high. So all of this has just meant there was a short-term bias for selling the pound US dollar. Now, the difficulty with this trade is that the move down is into this resistance, into this support level here at that 3730. It's the first kind of trouble area. So it's not surprised to see a bit of a battle going on there, okay? Now, so it's not necessarily a trade to hold, but we're looking at the risk tone. If the dollar moves higher, then that'll drag the pound US dollar a bit lower again. And what we want to look for is the risk tone. Now, you can see bonds are just pushing a little bit lower here. Now, these bond yields are continuing to move lower. Why? It's a little bit of risk aversion creeping in, right? So we just need to watch out for that going forward, that the risk aversion doesn't grow, because it could well do grow more and more And if it does, then the sharp move lower in bond yields could spark risk-off trading. That would be yen strength, Swiss franc strength, and dollar strength. So that does also make that gold outlook tricky, because if we suddenly see dollar strength come in, then gold will sort of move more sideways to flat. So watch out for that in gold. The other market to look out for is nat gas markets. If this keeps moving higher, that has the potential to spark further risk-off trading. The sharp move higher in nat gas prices at the start of the month did result in some risk-off trading, right? And it has the potential to do the same. And also, higher energy prices equals more inflation risk, because the more things that the higher energy goes, the more input costs there are to products. Products are carried to factories via trucks, planes, trains, ships. Then the completed products are carried to the consumer. The consumer even will often travel, or the consumer's product is delivered. All of this uses energy, and if energy prices are high, it means input costs are high, and it means inflation is expected to be high. So this in itself can impact markets which are very sensitive to inflation. So just watch out for that. I think the trouble area would be break back above 6.6, but just think that could change the risk tone. It's definitely something to be aware of. Oh, Josh. Yeah, are you bullish pound at the moment? No, I'm not bullish pound. I was bullish pound, Josh, and this is a good learning, okay? Because like I was bullish the pound like around the start of October, and then there was like growing expectations of, you know, the Bank of England hiking interest rates early, okay, to control inflation. All of that was supporting the pound, Josh. But those positions started to look stretched, right? And you can just see the Sonia futures. You see, it was around like the beginning of October, a number of like central bankers, Bank of England's Bailey, Bank of England's Saunders. Can you see here around the start of October? Do you see the way the Sonia futures sharply move lower, Josh? That was on expectations of interest rate hikes are coming, right? So, but they reached a point of peak kind of bullishness around the pound, and everyone's like, really? Is the Bank of England really going to raise interest rates 5 times? You know, it's just not, it doesn't make sense, does it, Josh? You think about it. If inflation is rising because of supply chain issues, how on earth is raising interest rates going to help the economy? Because all you're doing is you're making business conditions even harder for companies. So not only do they have to deal with high input costs, but now they also have to face higher interest rates, which means it's harder to borrow, which means interest payments cost more, right? It's all a nightmare. So that's the reason, Josh, that I'm not bullish the pound right now. And I'm looking for a sell the fact response from the Bank of England in November the 4th. Now, it's all going to depend what they do, Josh, like always, okay? What are they going to do? Are they going to be hawkish? Are they going to say, you know, the markets have got it spot on? Or are they going to be more dovish and say, actually, you know, the markets have really priced this wrong, we don't know what they're talking about, in which case, but euro pound upside and pound US dollar downside. Now, looking at the pound US dollar, can you see, Josh, this key trend line, 1, 2, that's close enough for 3. So that trend line has been tested, rejected, and that's a false break of an inside bar. That does signal lower prices technically. Now, that in itself is not a reason that I'm bearish the pound, but medium term, I do expect pound strength. Short term, I'm expecting some more weakness. Josh, I hope that helps. I hope you can see some of the rationale for that. And remember, you're trying to put a picture together. Yeah, great, Josh. Right, Josh, that's brilliant. I'm really glad you said that, because this is an area where folks get confused. And I have 100% sympathy with folks who got confused, because when I was first starting out, Josh, like, when I say first starting out, I don't mean first starting out trading. When I was first getting to grips with the fundamentals, I got the concept, you know what I mean? Raising interest rates, you see the currency being strong, right? But this is the bit you need to be aware of, is the market is usually much, professional traders in the market is usually much quicker than the average retail trader, Josh, right? And this is why, because look, do you see those SONIA futures? Do you see how, so basically from the start of October, that's when I was bullish pound, right? And so you can see these bullish, all of that was supporting the pound for like a good like 10 days, right? And then there reaches a point where the market is, it's not that the market is now bearish the pound, but it's like, you know, things retrace. So if you just look, just take a look at any price chart, you know what I mean? You just see that things, they retrace, you know, things move in waves, up, down, up, down, up, down. You can see, like, you know, there's these waves, there's retracements. So you see, we've had early October, we had the strength in the pound, we've reached a new term resistance level, and now it's like just do a little pullback. Now, the question is, what will the Bank of England do? So now you've got like 4 or 5 days where no one's going to be wanting to do much in the pound now, Josh, because you've got the Bank of England meeting on the 4th of November, like Thursday next week, I think. So then everyone's been like, well, what did the Bank of England say? Are they more bullish or are they more bearish? And then you get a new direction. Of course, you've got to factor in the US dollar into this as well. But that's what's going on, okay? So your analysis was spot on. Raising interest rates, you think pound should be bullish, and you're right. But always, always, always think, you know, how long has that been the case? It's just the same like with the Aussie dollar. Like, if you look here, you see the Aussie dollar, look how bearish it is, right? Now, it was like 1 or 2 weeks ago, my colleague was talking about this, and he was like, look, the Australians, it's oversold, right? There should be a retracement. And then he was looking, and I remember, you just have to take my word for this, Josh, but, you know, you just have to believe that I'm not making things up here. But he was talking about like a retracement due in the Australian dollar, and he flagged it all on, you know, he flagged it all up nicely. Looking for an Australian dollar, New Zealand dollar retracement. I'll just show you here. And it was just in a break of this channel here, right? He traded it as a channel. For me, like, it's just a simple trend line. It really doesn't matter which way you see it. But he was like, okay, look, you know, around the turn of the month, the Australian dollar really looks oversold now. And he took a nice trade back up to the upside, right? Just in the retracement. It's not that he was bullish the Australian dollar. He was just like, this is peak, you know, peak bearishness. That a retracement is due because things retrace. And then and again, this is all documented, I then traded Aussie New Zealand dollar short back down to the 200 exponential moving average, because that was in line with the fundamentals on a medium term basis, right? So medium term, we're expecting more downside. We had a slight retracement higher because the Aussie looked overly sold, but then we moved back to that 200 exponential moving average on the daily chart. We had a trend line break. It just made sense to see a little bit of downside, okay? And so if we look at it now, let's look at the Aussie 10-year bond yield spread. Look, you can see like that is a strong divergence. So that's worth selling here, because you've got Aussie 10 years moving lower, and the Aussie New Zealand dollar tried to move higher and failed, right? So that is signaling a decent short. And if we look at that on the 4-hour chart, can you see that? Look, price moves higher, but the bond yield spread's moving lower. So it's just like, you know, it's a really good shorting opportunity there. And stocks can be managed just above that 100 exponential moving average. So is the Aussie bullish? No, it's not. Is the New Zealand dollar more bullish than the RBA? Yes, because the RBA wants to hike, doesn't want to hike till 2024. The RBNZ wants to hike 4 times next year. Josh, I hope that gives a bit of colour, right? Yeah, Josh says Sonia Futures is something I've never heard of before this webinar. I thought she was just a character off EastEnders. Sounds like she should be, doesn't it? Yeah. Just these little intermarket correlations help. Yeah, they just help illuminate the way, help you get out of losing trades more quickly, and can signal winning trades nicely as well. You can see here, look at that bond yield divergence. Price higher, bond yield lower. It is signaling lower prices to come, which is, you know, very, very helpful. So look at that. Look for the close. If you get close within the body of that previous day candle, that would be a lovely signal to go short. Yeah, you're welcome, Josh. Yes, that's it. News cycles, how long they last. That's the bit you're trying to get. Basically, think to yourself, you want to be on it as early as you possibly can, right? You want to get into these things as you see them breaking. You don't want to be the person who, like, you know, we've been talking about this for 3 weeks, and now I'm suddenly, you know, gonna act. You know, it just takes time to get that skill. And the bottom line is what you should expect is that basically expect markets to be much more quick than you would anticipate. Just speed it all up in your mind. By the time someone's known something for 1 or 2 weeks, it's pretty much priced in, nearly always, all right? Constantly analyze what that story is. Okay, folks, it's been an absolute pleasure to be with you. Josh, thank you for your questions. They've been insightful. I hope everyone has a really good rest of the session. Don't forget, I'm back here on Monday. So if you want to get another look ahead what's going on, don't forget Monday. We'll be looking massive week next week. Loads of central banks meeting. You don't want to miss this webinar. Okay, folks, take care and have a really good rest of the session. Thank you now. Goodbye.